One of our favorite guests joining the program. He's the co-founder and wealth advisor at VestGen Wealth Partners. Craig, the market's up today, up yesterday as well. We seem to be kind of navigating the whims of whether the president does or doesn't want to fire the Fed chair. This doesn't seem like a healthy way to navigate through trading, but what do I know?
John, what does anybody know? I don't mean to laugh out loud, but it's wide, it's varied, and there's an entire range of outcomes that could occur. What I'm focused on right now, John, is this. The gap between soft data, which is survey sentiment, and hard data, the statistics, it's as wide as I've ever seen it in my career. And normally, John, when sentiment tanks like this, meaning everyone feels so bad, the hard data usually tanks relatively quickly with it. But guess what? We haven't seen that happen yet. So I'm not saying the U.S. economy won't slow down, but the reports of the U.S.'s complete demise, I think they're premature. This is going to take time to, reveal itself.
I get what you're saying, that vibes bad often leads to things being bad, and there's probably a lot of historical data to back it up. But Craig, we're in such a weird world these days politically that just in 2022, although we had bad data with the inflation, we've been in bad vibes on the economy for years, and we haven't had the recession yet, right? Like, we have just been a bad vibes country, I feel like, for a while now, economically speaking, and perhaps otherwise.
We have. I mean, the U.S. economy has twice in the last 5 years totally defied expectations and stayed resilient. COVID and the gigantic interest rate surge of 2022. And in both instances, everybody predicted this massive loss of momentum, this huge recession. But both times, the U.S. economy proved more resilient than expected. And all of that is because the consumer was more resilient than ever, causing me to say on your show, not once, but 17 times in the last several years, don't bet against the American consumer.
I think we're just too cranky. And it's almost comedic when you look at the division of the parties. When you ask Republicans and Democrats how they feel about the economy, the seesawing that they do immediately on January 20th, 2021, when President Biden takes into office, and on January 20th, 2025. I mean, it's almost like you can't seriously ask a consumer now, how do you feel like the economy is going to go, without stripping away the political aspects of things. Like, we are so tied to our team that I think it is just causing chaos with any sort of predictive nature of what sentiment really is.
That is so well said. And that's why I'm choosing to focus on the hard data. Jobless claims, soft landing. Non-defense spending, soft landing. Retail sales, soft landing. Non-farm payrolls, soft landing. ISM for services, soft landing. ISM for manufacturing, dip below 50. All right. I'm seeing the first cracks, hard landing. So what does that mean for everybody? Go through your portfolio, be a little bit more measured, be a little bit more intentional. Don't play the hero. There's no room for bravery in this market. And as long as you're executing for a plan, and that plan is backed by data, this too shall pass. But you're right, John. The intersection of sentiment, data, politics, what's reliable anymore? I feel like we're living in the upside down world.
Yeah. Some people texted in, well, I look at my 401k and it's bad, and that makes me feel bad. I mean, I get that, and I felt that way too the last couple of weeks here and there. But again, the broader trend certainly is our friend, Craig, when it comes to maybe where we could be a little bit more reasonable in our expectations. I mean, the S&P 500 is up about 90% over the last 5 years. And I'm not saying the downward trend that we've seen over the last 4 months is nothing. I'm not trying to minimize it. I don't like looking at it either. But I think that sometimes the longer plan, I mean, that is really what most of us should be looking at when it comes to planning for retirement.
That's exactly right. We've been in a downward trend since the 19th of February. So it's been 2 months and 4 days now. That's it, 2 months and 4 days. And that does not mean I'm dismissive of what's happening. everything that's happening is incredibly newsworthy. Everything that's happening has the potential to really have an impact. But you're right. We need to be looking at what we're investing for and aligning that timeline of what we're investing for with our emotions in order to make good decisions. Because, John, there's people that sold out 3,000 points ago on the Dow. That was what? 2 weeks ago? How did that feel?
Right, exactly. We talk a lot about timing the markets. You got to get it right twice. This is not the time to be trying to play that game.
No, it's not. That's why everybody should stay disciplined. And people should have a game plan above the current market price. People should have a game plan at prices well below the market price, that when those prices get hit, it causes discernible action. But that's not discernible action that's wholesale change. That's discernible action that is measured change, because it's incremental progress at the margins that are the hallmark of every great strategist, because you don't want to be average. You want to do better than average, and that means doing your homework.
What's your take on Tesla? A couple weeks ago, I talked to Tom Appel, who at the time we only had data from January, who saw the numbers on the walls were not good year over year from January. This was before Doge. This was before we saw the protests at Tesla factories. And now we see revenue just tanking at Tesla. You see competitive EVs all over the place at a bunch of other countries. The market share of EVs with Tesla is down. Craig, is that a stock you would, I guess I don't want to ask for specific stock advice, but what's your take? Is this company savable?
Well, I think the company is definitely savable, but the Tesla premium is no longer there. The Tesla exceptionalism is no longer there. And I think people don't need to look much past the headlines to see that what was released here recently is that Elon Musk is going to be stepping away from the time he's spending on Doge to work on his core competencies, and that's because you have a stock that's in transition. But when I look at Wall Street price targets, I mean, there's 54 companies. Some people think the stock's going to 465. Someone thinks it's going all the way to $19. But if someone were to say, will Tesla ever start with a 3 again, meaning be a $300 stock versus the $250 stock that it is, I think yes. And I think yes for one reason. I think even though there's a revolt against Elon Musk by some, I do think EV and hybrid is here to stay, even though we still have an insatiable demand for light-duty pickup trucks in this country. And that doesn't make Tesla a screaming buy, but it still makes it a relevant investment.
Got about a minute left. David Jennings in the newsroom. Quick question.
Yes, the question is there anyone at Tesla that can get him to just keep his mouth closed? Because it seems that is his biggest failing. He doesn't know what he doesn't know.
Craig, you know anything about the inner workings of Tesla?
I don't, but you're right. A lot of people just seem to get in their own way these days.
Yeah, that's well said. And a good answer at that. Craig, we're out of time. You do such great work. Get retired, stay retired. During these up and down times, you want to be chatting with Craig. Tested in the trenches, as you love to say, Craig. You're a good man. Thanks for speeding through it today. Get retired, stay retired. Take care, okay?
Be good, John. Thank you.